to be in this class. This is just to um, skill you up, to arm you up in terms of knowledge. And anything beyond this, you're welcome to study, to dig in, and so on. But while we're here, my goal is to teach you the basics so you can get into the market and you can be able to make pips without having to memorize many things, without having to learn so many things, without having to be glued on your TV for the news. Okay? I'm just teaching you what I consider the basics, the fundamentals. All right, back to Forex. So there are only about 2 or 3 things that I want to talk about, but again, they will be a little more in depth. Yeah. And the first one is just the market structure. You know, when you look at the market, what is the structure? How does it look like? Okay. And fundamentally, after you look at the market structure, then the next natural thing to look at is support and resistance. What support is, what resistance is, why are they important? Okay. And then trend lines. Again, the same thing. What they are, why are they important? Is it important to even to know them? And trust me, once you know those 3 things, you are halfway home in terms of trading Forex. Some people make it complicated. You know, you look at the charts are messed up. They have all these indicators on this and that and that and that, and it becomes crowded. So my goal is to demystify that. Okay? Demystify it so that you don't have to worry about all those things. You can go in and get out. Okay? Go in, do your analysis, and do some trades and get out. That's my goal. So having said that, then let me see if I can get to the charts where we can start looking at our analysis. Okay. Um, oops. Oh, okay. I'm going to use a different platform here because I think I want to pop out there. I'm going to pop this out there. And then this is what I call a basic chart. I'll remove everything. Yes, there you go. Can you all see that? So the only thing that is here is basically the candles. And if you can see the candles, then you're good. That's all you need to see. Okay. All right. So when somebody says they want to look at the market structure, what do they mean? It means that you want to have a bigger picture of the market and essentially where it's coming from, where it is, and basically kind of where you think it's going. All right. And sometimes that question can be very interesting depending on, not who you ask it to, but the different time frames you ask. Okay. So this is Euro USD. All right. If you asked right now, this market, what do you think is going on? Is it going downwards? Is it going horizontal or is it going up? Well, because I've tried to maximize it, from here you can't see much. But you might think that because, the last part of it, you might say it's going down. Well, is that true? Now, if you scroll backwards, this is what happens. This is what you see. Okay. But if I change the time frame, I wonder if the answer will still be the same. So that's 1 minute. If I go to 1 hour, would your answer still be the same? It looked like it was going down, but look at the 1 hour. The 1 hour suggests that actually it's going up. It's going up, it's consolidating somewhere in the middle here, and eventually it might continue going up. So the market structure or how it looks like depends on the time frame you are using. And that's why it's very important early on to determine a few things about yourself. One, what kind of trader you are. We have a full video, a long video in the YouTube that can help you establish or determine what kind of trader you are. Okay, and of course there are many factors that psychometric evaluation does. Okay, it gives you some questions, it analyzes, and then eventually it gives you the answers that can help you demystify that thought, so that then you know that, hey, okay, seems like I like fast-moving markets. I am an impatient person. I can't wait for a week. Or if I put a trade now, I have to know what's going on by the end of the day. See, all those things determine who you are, hence the type of markets you are likely or you will or you should be trading. So for the longest time, I thought I was more of a, like a swing trader, like do a few days, I'd be okay with that. But then I'd find myself waking up in the middle of the night to check on the trade. So you take your trades in the longer time frame. I would use the weekly to plan, and then daily, and then take like 3 or 4 hours, actually 4 hour trades, and those could go on for a few days. So yes, they're kind of nice, and because they're kind of nice to look at. And people draw for you charts. They show you the analysis. They kind of look cool. Like, hey, this is a 4 hour. This is daily. And you feel like you actually want to join in, but then you find yourself waking up at night or 3 o'clock in the morning, or every time you get a chance when you're going to the bathroom, you want to look at the charts and say, what's going on? Where is the market right now? Am I about to take profit? So that's the kind of thing that I found was going on because I was doing those swing trades where they don't end in one day, they end 2 or 3 days later. But with time, I realized I'm impatient. I don't like that. I actually want to take my trades, and by the time I go to bed, I don't want to have anything running, no trade running, which meant I should not be doing 4 hours. I should not be doing even daily trades. Probably 1 hour, but even then, shorter time frame. And that's how I transitioned from the long time frame to the shorter time frame. And so while I was in the shorter time frames, then I thought, okay, fine. I look at the charts, I feel like, yeah, they look okay, but is it possible to get results here and now? So what does that mean? It means that I have to trade and be done with the trade when I get out of the chair. Okay, that's another whole story. But for now, let's first start with that transition. When you have big money in your account, you can do monthly trades. The likes of Warren Buffett, the richest guys in the world, they don't do daily trades like you and myself. No, no, that is too small for them. Okay, they like to do trades that run for a long time. So they do like monthly, weekly, without having to worry about, how low it will go, how high it will go. So the forex market can go way back, way back. I think this chart allows. Let's see, oh, 2005. So it can go way back depending um, on the chart and the uh, broker, their system. Let me see the other one. How far back? Just 1 second. So, oops. Okay, this one might have a date. The other one didn't have a date. I want to see if this one has a date. Uh, okay, so on the daily chart, monthly, yeah, this one has dates. Okay, this one goes as far back as 2011. That's a long time ago. 2011. Okay, so you can imagine they started keeping records. We're in 2020, almost 10 years of records that are there. So if you look at this, you can say that maybe the market, from the time, quote unquote, it started, has been going down. This is a Euro USD. But basically, maybe it has been going down in general. It's been on a downfall like that. Okay. Oh, by the way, this is what we call a trend line. Okay. I'm trying to make sure that it touches the body on one side and look for another body somewhere and touch it. Ideally, you should touch at least minimum two, but ideally three. Okay. So when you're drawing your trend line, okay, you should touch minimum two, ideally three. So you can work with two, that one and that one, okay, assuming this is complete, but three is better, okay? And because it is slanting, that's why it's called a trend line. Trend line. Okay. What is the significance of a trend line? Well, the trend line just indicates to us that the market has been on a particular general flow, whether it's down or up. So in this case, looks like it's been on a you know, downtrend. But again, we're looking at a very big time frame. This is monthly. Now, if you look at smaller time frames, then the case will be different. So for the big investors, they would look at this and say, oh yeah, okay, fine. The market has generally been going down. So they put money and they know they can check it after 1 year, or they're not even interested. They'll check their balance after 1 year, and they know that the market is going down. So generally, 1 year down the line, I should be doing very well. That's their thinking. All right. So we go daily. Now look at daily. So for you and myself, we look at daily and say, man, the market is going up, crazy up. Okay. Whereas the other one was going down. Okay. Let's see if I can clean this. Okay. So on a daily time frame, if you look, the market seems to be going up. So you might be tempted to say, we can go and buy. But buying is okay if you're a trader, maybe who looks at the charts maybe once every week, maybe on a weekly basis or on a monthly basis. All right. So the assumption is you'll have looked at the weekly, and then you come to the daily because you want to trade in the daily. So here it's going up. But again, I believe most of you are not in that category for long term. So let's go to a little more realistic, something a bit more realistic. Uh, the 4 hour for analysis, hence you're trading the 1 hour. Now, if you're trading the 1 hour, chances are your trades may end up closing by the end of the day and sometimes the following day, but not more than a day or two, usually. All right. That's for the 1 hour. Okay. But you use the 4 hour to actually take your trades on the 1 hour. Now, if you know you're busy, you don't have time to look at the charts, and you think, I can only look at the charts over the weekend and put my trades Sunday night or Monday very early in the morning. Well, then the daily and the 4 hour trades are perfect for you. All right? Perfect for you. There's a general rule of thumb. It's not a matter of life and death, but a general rule of thumb that if you want to trade a market or a particular time frame X, okay, you must use uh, five, I should say 4 to 6 or 5 to 6 X time frame. Okay, so that means if you're going to trade 1 minute, then it's a good idea to check a 5 minute time frame. Use it for your planning. If you're going to trade a 5 minute time frame, then it's a good idea to use the 30-minute time frame for your planning. If you're going to use 1 hour, okay, let's say 15 minutes, okay, then here you can get away with 1 hour, okay, or sometimes we have 2 hour charts, right? 30 minutes, so there you start getting a bit woozy. There's 2 hour charts, by the way, even on this platform. Okay. So times 5, you get about 2.5 hours. So, but you can use 4 hours. Okay, H4. Now, this is not a hard and fast rule. There are some people who argue that any factor 4 to 6 is good, which means for something like we're going to trade 1 hour, then use the 4 hour charts plan. So no hard fast and rules. However, the more popular ones that people use mostly are the 4 hour. Okay, that means they use the daily for their planning. Okay, so 4 hour for trading, daily for planning, 1 hour for trading, 4 hours for planning. The 30 minutes is not very popular, but if you have to use that, then use the higher time frame to plan. Again, the smaller scalpings times are very popular, 15, okay, which is 1 hour, 5, and then 1 minute. Oh, must you use this? No, but it is advisable. Why? Because of, I think I've mentioned this several times in this class, but I'll say it again, the fractal nature of currencies. What does that mean? Basically, it just means that the currencies have a way in which they mimic or they repeat themselves over time. Okay, which means that if you look at a bigger time frame, so a bigger time frame from here, from A, okay, to B, would look maybe something like this. Okay, so maybe that's a bigger time frame. Now, a smaller time frame, again, the fractal nature of currencies is such that it keeps repeating itself. Okay, so this is very simple, very clear. So you'll find that maybe a smaller time frame would mimic this, go like that, like that, okay, like that, like that. Okay, so it repeats but curves in so many times, so that whereas to go from here to here, there's only a straight uptrend, but on a smaller time frame, it has gone up and come down and gone up and come down again. Now, on a much smaller time frame, something similar happens, only a little more busy. Okay, so from here to go up there, you have like that. Okay, so same thing. Okay, sorry, my drawing is not very good, but assume these are like up and downs, up and downs. So I'm trying to draw, but drawing this thing like this is difficult. Okay, so from here to there, even though it looks like it's just up and down, on a smaller time frame, it looks, like you're going up and down. And the good example I gave you guys were if somebody is traveling maybe from Nairobi to Mombasa or Nairobi to Kisumu, whereas it looks like a straight line from Nairobi. Okay. Oh, that's Mombasa. Okay. So this is Nairobi, and this is Kisumu. Somebody might argue that, oh, it's just a straight line. Yeah, that's fine. If you get in the plane, you're there. Or, down like that. But if you're on the road, you have to go up and down, left and right, and so on until you finally reach there. So the markets are like that. And what is the advantage of that? Well, the advantage of that is then, once you have the general direction, the rest are details. Once you know that the market is trending up, the rest are details. That's why you take advantage of that. Okay? You know the market is trending. It's going up. So what's the time frame? This is 4 hours. So then what do? You drop down to your H1 and get the details. And what is the details? Well, the details are it will go down and up, down and up, down and up, but it will maintain the trend, which is actually uptrend. Okay, that's why people can go down, then trade up, buy, they wait for it to go down, they trade up again, goes down, they trade up again, and so on. This is very popular among scalpers. They fully take advantage of that. But for long-term traders and other traders, they don't so much take advantage of the downs and the ups. They just say, okay, it's an uptrend, fine. I'm going to ride it until the next support line. All right. Back to, I'm going up and down, but I hope it's all good. So the first thing I normally do is I make sure that I look at my charts and mark the significant turning points. Now, I am a scalper, so I might be a bit biased, but let's say in general, most of you will be doing day trades or 2 or 3, 4 days swing trade. So maybe you might still do daily. So we go to daily, and then what do? We try first and minimize it to have a general feel. Okay, you see where the market is. Please always make sure that even as you make your chart, you have focus on where the market is. Otherwise, if you don't have focus on where the market is, you might end up doing analysis and forget where the market is. So whatever you do with reference to where the market is. Okay, so I'm going to do it like this from here because the screen doesn't allow me to go backwards. Okay, and I want to make sure I show you where the market is. So from where the market is, I need to mark all the significant turning points. Now, I think I mentioned this in many other classes before. A significant turning point is a point where it's very clear. You can open your eyes and you can see that, yes, the market turned there, okay, without having to think so much, right? So I'll look here and I see this is the last, on this chart here. That's a significant point, okay? And you can almost pick them out without thinking very much. At the bottom, you see there, okay? And you don't think so much, remember, because these are not exactly lines, they are zones. So even though I'm putting lines, just remember around that area, the market was significant. And what does significant really mean? It means that the market obeyed that line. When it came there, it either paused and turned, or it stuck there for a while before it moved on, right? So on the daily time frame, this is what I've just put right now. Is it 100% perfect? No, it can't be perfect because everybody has a way of marking their support and resistance. Okay? But the general consensus normally is you mark the body of the chart, not the wick. What do I mean? If you look at this, okay, right here, we're looking at the body there, not the wick. The wick could be there. And that's why we're saying it's a zone. So you'll find in many newer, what do you call them? Newer platforms, they actually put a zone. By having a zone, it means, let me see if I can have a tool here. An eclipse triangle. Now, a zone, basically, you'll find that this whole area is shaded. So you can almost say that if I put another line there between the wick, okay, those two lines. So somewhere in between, this is a zone, okay, it's a zone. But in terms of your planning analysis, you use this one, the one on the body, okay? And you might find that from the wick, top of the wick to the body, it might even be so many pips, but that's okay. This is a longer time frame. Now, we learned that really the reason why we have a wick is we say that yes, that is the highest the market reached, but it closed. Okay, it closed at that point, especially for a market that's going up. So this is the highest it reached, but it closed there. All right. Now, this is a daily time frame. So once you do this, and you do this especially if you're going to be trading either the 4 hour or the 1 hour, okay, because it helps you have structure. So you go then to a smaller time frame. So please note the colors are white, okay? And I think I like what Ken normally does. He then draws others. They might even be different colors. So I'm going to go and do the 4 hour charts. And if you look at the 4 hour chart, they will generally obey what we put for the daily, generally. Okay. So you only add on if you feel there's a significant point that they've daily missed. So like um, here it seems like this market has touched this point 1, 2, 3, 4, 5, what 5 times. So we can add, but we can change the color there. We can say, let's make this yellow. Come here, you change this to yellow. You could even change the thickness. If you want it to make to look pretty, whatever, I could have made this white and big, All right. So I've used that. Then that's okay. Anywhere else? Yep. This one's here. They seem to be just around here, and because it's 4 hours and maybe you want to trade the 1 hour, if you're just going to trade the 4 hour, you can leave it like that. Okay. So you're just going to be trading between the big daily zones. All right. So what does it mean? It means that now you use that information to trade. So if the market is at a point, okay, we have 5 minutes. This time always goes very fast. All right. Okay. So how do you trade this? Well, assuming that the market is at a point X, okay, you ask yourself, where has the market come from? It's come from here, okay? And so you're not aware of all this, but you are aware of this point, you are aware of that point, you are aware of this point, significant points. So if the market comes down here, when it touches that point, three things can happen. You can consolidate and go back. That's one. Or it can consolidate and continue going on this way. That's two. Or it can go down. That's three. Three things could happen. All right. For you, when you get there, you don't worry about the middle part, because the middle part, half the time, most people don't know how to trade them. So for you, you only worry about 1 and 3. And often around there, you'll have gotten a signal from the candle patterns. Remember we talked about the candle patterns? The signals will tell you if this is actually going to be a reversal pattern. Okay? Often you see a reversal. It might be a breakout or whatever it is, but if it's gonna go back up, it'll show you. Now the same thing happens when you are anywhere. If you are somewhere in the middle there, a decision will have to be made. So every time you reach in the middle, you'll have to make some decisions. Why? Because the market is touching a significant level. So, but between the significant levels, it's just maybe, for lack of a better word, trending. might be trending up, trending down. So here, trended up a little bit, again up again, then trended down. Okay, then here consolidation, or it went down again, consolidation up, and then down, and then down, and then up. So we said about 30% of the time the market will be doing its trending up or down. About another 30 or something, it will be doing consolidation and other. All right. Okay, we have minutes. We didn't ask questions. Can I reset the meeting, or are you guys okay?
Reset the meeting.
We reset the meeting.
Can reset the meeting.
Okay. All right. I'm gonna get out and then reset, send the link right away. Okay, then we can continue.